Hi, this is Jenn Carr from Your Credit Mechanic. You know what, I wanted to talk today about what makes up your credit score. Sometimes there's confusion about what are the pieces of the pie that make up a credit score. So, there's about 5 pieces that are of the utmost importance that you should understand. The first piece of the pie, and actually the quite largest piece of the pie, is past payment performance. Most of us know that we're supposed to pay our bills on time, and therefore that's going to bode well for us. However, past payment history is really the last 2 years are the most important. After a major event, you want to turn around and really protect yourselves within the first 2 years. That's about 35% of your credit score. So you do want to make sure you pay bills on time. Even silly things like letting a library book go overdue and not paying that collection on it, it can actually get back into your payment history. It's one of those crazy things, but past payment performance is important in your credit history. Second thing, credit utilization. Let's just say, for round easy numbers, you have a credit card, $0 to $1,000 you're able to borrow. Credit utilization has to do with how much of your credit are you using. So for this card, if you use more than 40% or $400, as soon as you go above that, if that has to revolve, meaning it has to take you a couple of months until you pay it back down to 0, or at least below the 40% mark, you can actually lose credit points. This is also an important factor in your credit score. Credit utilization, you want to keep your balances below 40% of the available credit limit. So for a $1,000 credit card, that would be 40% or $400. When you go above $400, you start to lose credit points. As much as, think about it if you have a credit card that's maxed out, 90 to 100% utilization. You could be losing 60 points a month just on that credit card alone. Now let's talk about length of credit history. This is important too. When we were young kids, 18 years old, just building credit, we sort of don't exist to the credit reporting agencies because we've never had credit before. So you have to work at building a credit history. Just as important when you're on the opposite side of that 18-year-old kid, you want to hold on tightly to any credit history you've built. So if you've had a credit card for the past 10 years and you have an option of closing that one and opening a new one, what do you think would bode better for you? A credit card that has known you and given you credit for the past 10, 15 years, or opening 2 brand new cards who don't know you from anyone else in the world, and they're going to give you small, maybe $1,000 balance to use, or I should say a limit to use. Obviously, you want to keep your oldest credit card. Now, if you've had a dispute with that company, maybe you don't like their practices, the important thing is you still want to keep it open. Maybe you occasionally use it to buy something and pay it off to 0 so that you're not using any of that interest, but just important to remember, you want to keep that credit history. Now let's talk about types of credit. There are what I like to call the top of the echelon. That's a mortgage, that's a student loan, that's an auto loan. Those are installment loans. They are very, very high quality pieces of credit. However, when you start to get into credit cards, they start to vary a little bit. It could be a high credit card like an American Express, a Visa, or a MasterCard. However, when you go into store cards where a store has its very own credit card that can only be used in that store, that's a different level of credit. That's sort of not as high quality. We'll call it low quality credit. Same thing is if you walk into a furniture store and they offer you 90 days same as cash. It's a credit line of sorts. It becomes what is just known in the revolving credit world as a giant credit card. So maybe it's $3,000 to buy that new living room suit. You have to remember that that also is considered a revolving credit card. So you do want to get it paid down as quickly as possible. Those are the different types of credit out there. It's a mix of credit. That's what they want to see you carry. It doesn't have to be all one thing, but like I said, installment, mortgage, those are higher quality pieces. And then the last part of your credit report is the credit inquiries. How many times have people pulled your credit to see if you are viable to get more credit from them? These things can be anywhere from 3 to 10 points when they hit your credit score. It's something to be aware of. For example, when you go in to buy an automobile, if you let the dealer pull you, they might pull you several different times. So it's important to know sometimes walking into the the car dealer, exactly what you want. Sometimes even walking in with your credit score or credit report is even helpful. So credit inquiries are about 10% of your credit score. So again, past payment performance, credit utilization, length of your credit history, types of credit used, and then credit inquiries. This is what makes up your credit scoring financial pie. For lack of a better term, this is Jen Carr with your Credit Mechanic, and just another tip from the Credit Garage.